Yeah, I'm losing my edge.
The difference between stock and futures options, I thought nobody better to go over this stuff amid the launch of small exchange futures options, to do it with the best person on the board, in my mind. Don't tell everybody else at the network. It's Mike Butler, because he is just honestly, I don't know if you reflect on this very often, but you are probably one of the prominent voices in options education for the last decade. If you're perusing YouTube or wherever, you're likely to see this guy's face. And you've done a ton of work on stock options, but we're gonna test out some futures options stuff, and hopefully it's not too different. But you've traded futures options before, right?
Yeah, definitely. And if you understand, really the biggest hurdle is always going to be your notional values and tick sizes and whatnot. But that doesn't exist with small exchange, which makes it just that much easier. So I'm super excited for the launch of options.
Hell yeah, man. Yeah. Hopefully this is kind of a quick conversation. We'll brush up on options, get to stock options, futures options after that, and just land at, I just have two quick examples for what small exchange futures options, a couple of strategies would look like. And we'll get to what those look like to end the show here. But first off, just letting you know, I know a lot of you out there are probably like, yeah, I know this stuff. I've been trading options for a while now, but all the newbies out there, options essentially, in my mind, I'm trying to whittle this down to the smallest, most just simple definition. Options let their buyer buy or sell a market at a specific price by a specific date in the future. Call and put options, essentially, call options are obviously to the upside, put options to the downside. Both of them together, though, if I'm buying either of them, basically, Mikey, what I've allowed myself is the ability to buy or sell that market at that specific price by the expiration date. And that's just a quick example. You see the graphic here. If the market's at 70 and I buy the 68 put for $1.50, I've essentially paid $1.50 to have the ability to be short that market at 68. Now, if I do that on the call side, market's at 70, I buy the 72 call, Mikey, I'm basically paying that $1.40 or what have you to have the ability to buy that market at 72. Am I missing anything there? Or how do you kind of tell people for the first time just what options are?
No, I think you hit it on the head. And I think the big thing and the reason why people might say, like, why is it so cheap for me to get all that leverage? And the reason is because you have a static time frame. You don't have a time frame that is infinite, I should say. Where if you buy the shares, you're buying them at the market price. You have no time frame as to when you close them. But with an option, if you're buying the 172 call, you're only putting up $140 to have the theoretical equivalent of 100 shares at 72 because you have a limited time frame. But you also need the current stock price to go above 72
exactly
for you to retain that value and gain intrinsic or real value. If you don't, then you're out the 145, and that's how the leverage is really created with buying options in a market.
A lot of pros and cons to all of these things. And it's actually one of the beautiful, as you get deeper, we're not going to go into those pros and cons, but as you get deeper into this, you see that every single one of these strikes, every single one of these prices, stock options or futures options, any derivatives market is so efficiently priced in its pros and cons. Like, it's like, oh, I buy the 72 call. Oh, I have infinite upside and I only have to pay I only have $140 in risk. That's awesome. But it's got to get there, friend. And it's got to get there by the expiration date. So a lot of different pros and cons there. That's not what we're tackling today. I want to dip into the difference between stock and futures options. Right off the bat, stock options, really as vanilla as it gets with a lot of this stuff. Almost any stock options market that you're trading is going to be 100 shares of the underlying market, American style options, which just means that you can theoretically exercise prior to the expiration. Trust me, that sounds scary. Don't worry about it so much. Very particular instances where that really comes into play. And one thing that's intriguing here, and it's kind of a big difference between stock and futures options, is the fact that these settle to shares. If you don't close the position by expiration and you're long or short in the money options, you're going to have some shares in your account, which is going to be a larger buying power almost 100% of the time. And you might not have wanted those shares. And that's called physical settlement. The difference here in futures is that these actually settle to the futures almost 100% of the time, but those futures in the small exchanges case and in the micros and a lot of other places, they settle to cash. So if I'm in the money or I'm out the money on my futures options, Mikey, when all is said and done, everything has just turned to cash in my account, which is actually kind of nice, right?
Yeah, and I've actually done that before. Forgot to roll a trade and just watch it settle to cash. Nothing changes. Your P&L is adjusted based on the closing price, and that's it.
Exactly right. And another quick intricacy here is almost all futures options are on one contract. And this is where stuff gets hairy when you're talking about like micro S&Ps. And it's like, oh, it's one contract. That's very simple. But the multiplier on micro S&Ps is 5. On micro NASDAQ, it's 2. Small exchange futures, the multiplier per contract is $100. And so 100 shares is in theory one contract of small exchange futures. So it looks and feels very, very similar with that multiplier. Here are the contract specs for the first options on smalls. Exactly right down the middle, hopefully what you would expect, American style, same tick size as the futures, same multiplier, same expiration date, and everything on down the line. Now, the last thing I want to hit before we get out of here, because we are running over time here, is just what are the possible outcomes for a couple of these strategies on SPRE, Mikey? If I were to sell, the market's at 73, let's call it, and I sell the 70 put in February 18 options, so that's the February the 18th, they're going to expire for 50 cents. What can happen here if the market goes higher? What can happen if it goes lower? And what can happen if it goes really low to my position? And then also by expiration, let's just start off with, if the market goes higher, what happens to my position?
Well, the really nice thing about short puts and why people use short puts as a way to bet on a market staying the same or going higher is just that you keep the credit received as profit. So you have so many ways for this thing to work out in your favor. As long as it stays above 70 in this case, you're going to keep that 50 cents. So if it goes down from 73 to 71, you keep the 50 cents. If it goes from 73 to 76, you keep the 50 cents. So it's a high probability trade because you can be profitable if the market goes up, down, or stays sideways. As long as it doesn't breach your contract at 70, you're going to be okay. But the nice thing is, like, what if you wanted the contract at 70? Then this is like a perfect scenario for you because you have the ability to get long at a better market price than you're being offered now. And you're collecting premium to take that risk. So a lot of people like short puts for that reason. I think it's a great neutral to bullish strategy, regardless of the product you're trading for that reason.
Absolutely. And yeah, if the market does get down to 69, 68, and it's February 18th, then I just lost the difference between where the market goes out and my break even, which is 69 and a half. So theoretically, if the market expires at 69 and a half, I honestly just get $0 in my account and I get my buying power back. So all pretty straightforward stuff here. We have one last strategy that we don't need to go super deep on, but this is where I always tell people, and I'm interested to see, Mikey, here to close, what you tell people when you're getting started in options on stock or futures, starting with the tightest defined risk spread, either buying or selling it. And in this scenario, it's a 20-cent spread. That's just $1 wide, the tightest you can get in SPRE options. That's where I tell people to go because it's defined risk. You can't lose infinite amount or thousands of dollars of money here. And in this scenario, you buy the 75 call, you sell the 76 call. It's a bullish strategy. And I can see that everything ticks the same as the futures or the stocks. And I can see my account fluctuating by $1 or $2 at a time and get comfortable in the space. Is that where you tell people to go first, defined risk spreads?
Yeah, definitely narrow define your spreads and not even with the expectation to like make a ton of money. Really, you're not going to lose a lot of money in this case, but it's so important to be able to just log on every day and see how these options are moving. And I think if you have a spread, you get the benefit of seeing two different strikes move in the inverse of each other. So you can learn a lot just by being in a spread and just watching it tick as the market moves every day.
Absolutely, man. Couldn't have said it better myself there. Thanks so much for jumping on. We have run out of time because it is such an eventful day in the market. Hopefully, Peter Momat is forgiving here on Monday afternoon. Thank you so much, Mikey, for joining us here on the show. As always, go follow Mike Butler on Twitter. Follow all of his trades on the Tastyworks follow page, and also check out his program at 11 a.m. Central Time every single day on the Tasty Trade Network. Mikey, thank you. Everybody out there, thanks so much for watching. Don't forget to follow Small Exchange on Twitter or follow me, Frank Caberna, on Twitter. You can always reach out via email or Twitter, especially on days like today with any questions. Thanks so much for watching. Keep tuned for Splash into Futures coming up next. Peace.